Good evening. This is our presentation on climate and ESG considerations. And today, this is what we'll be covering. This is our team that will be reporting our presentation. And my name is Max, and I'll be doing the introduction and perspectives. So to get started, ESG stands for environmental, social, and governance. These are three dimensions investors use to assess how sustainable and ethical a company's operation is. ESG investing is to evaluate investments based on performance related to this criteria. The environmental aspects regards climate impact, resource use, and pollution. The social aspects regards labor practices, diversity, product safety, and community relations. Governance aspects regards board structure, executive pay, ethics, and transparency. We must take into account corporate social responsibility, or CSR, which is a business model corporations and companies use to take accountability of their actions that enhance the impact on society and the environment. When it comes to climate investing, it involves filtering investments based on corporate responsibility and carbon-related aspects of ESG. Sustainable investing is the broadest of the three listed and considers the organization's decisions of the people and environments. Green funds are mutual funds or another financial instrument that would only invest in companies that are deemed socially conscious or directly promote environmental responsibility. To get started, ESG investing really started in the 60s when people stopped investing in synth stocks, which is tobacco, firearm, and gambling. Then people started to invest with sustainable integration, keeping in mind ESG factors later on throughout time. Big firms such as Fidelity Investments, BlackRock, and Vanguard integrate ESG factors into their investment strategies and services. The graph below shows how much money has been invested regarding ESG and impact funds. Now, there's two perspectives when it comes to investing. For the investors, some challenges are that greenwashing and inconsistent ratings can lead to confusion and mistrust. However, usually younger investors want a good majority of their investments to reflect sustainability or corporate social responsibility. ESG mutual funds, ETFs, and green bonds are ways to invest in this. Regarding institutions, they view ESG as a financial tool, not just an ethical one. They sometimes see sustainability as part of risk management or future profitability. Institutions who issue investment options may show that they allocate their funds in sustainable ways, such as renewable energy or eco-friendly technology. Policymakers are introducing ESG disclosure rules and incentives for green investments. All right, and listed below are the three most used ESG reporting standards. However, there are more than what are listed. The GRI, or the Global Reporting Initiative, is a global leader for sustainability reporting. The GRI standards allow organizations to report their impact on the economy, environment, and people in a comparable and credible way, increasing the organization's transparency and sustainable development. The GRI focuses on a company overall sustainability impact and is aimed at a range of stakeholders. The SASB, or Sustainability Accounting Standards Board, provides industry-specific standards to help companies disclose financially material ESG information to investors. It connects businesses and investors on the financial aspects of sustainability. It is specifically designed for investors since it focuses on the ESG issues that are financially material. And lastly is the TCFD, which stands for the Task Force on Climate-Related Financial Disclosure. Created 10 years ago, the TCFD developed a framework to help companies and organizations more effectively disclose climate-related risks and opportunities through their existing reporting processes. The TCFD developed recommendations of what companies should disclose to investors and lenders in appropriately assessing a set of risks. Usually related to climate change, it follows four thematic areas that represents core components companies should operate with: governance, strategy, risk management, and metrics and targets.
Hi everyone, my name is Jack Zaremsky. Now that you all have a better understanding of what ESG is, I'll be covering portfolio allocation. First, I'm going to tell you all about the different ways that advisors are able to integrate these ESG and climate-friendly assets into their client portfolios. To begin, I want to first talk about two different approaches of isolation versus integration. In this context, isolation means to look at ESG factors as an isolated component of the company. This could look like simply buying or refusing to buy an asset solely on the basis of their ESG score. On the other hand, integration is a more holistic approach in which you integrate ESG into other analyzed components, such as expected returns, volatility, credit risks, and liquidity. When investing in these assets, advisors can also use the top-down and bottom-up approaches. The top-down approach means looking at broader trends in the overall market. This could include factors such as government policies, carbon regulation, or climate transition pathways. The bottom-up approach would mean looking at more specific company-level data, including emissions, supply chain resilience, and company practices. These approaches will help the advisor perform client customization, which refers to aligning the portfolio with the specific values that are important to the client. Advisors are also able to use sector tilts in order to help make a client's portfolio. Sector tilts are intentionally allocating more or less to specific sectors. For an ESG-friendly portfolio, an advisor can use sector tilts in order to overweight investments such as renewables and underweight other investments that may be using lots of fossil fuels and other heavy emitters. By using all of these different concepts, the advisor will need to perform the actual asset allocation for their client. Asset selection refers to the selection of the specific assets that you will pick to invest in. There's plenty of data available that can help you pick specific assets, such as ESG scores and carbon footprint data. You and your advisor would then integrate this data with the other financial data of the company to decide if this is an asset that you believe is worth investing in. When investing, it is almost always beneficial to diversify your portfolio so you can minimize your risk while maintaining a certain level of return expectations, which is also known as the Sharpe ratio. You can diversify your ESG portfolio in three different ways, with the first being geographic diversification. In order to achieve geographic diversification, you can spread your exposure to assets all across the world with different climate, regulatory, and economic conditions and risks. This is very important because if a big change happens in the place that all of your assets are in, there could be lots of volatility. The next way is through asset diversification, and this includes mixing different assets instead of just investing in one or two. This could include investing in different equities, green bonds, infrastructure, and more. And lastly, advisors can use time diversification when constructing a portfolio. Time diversification means to have a portfolio that consists of short and long-term investments. The shorter-term investments can help the investor to manage any potential liquidity risks, and the long-term investment should aim to grow and appreciate over time. One of the biggest factors an advisor may look at for a client who wants an ESG-friendly portfolio is ESG scores. And these scores are given out to quantify a company's environmental, social, and governance performance. There are many different providers of these scores, such as MSCI, Sustainalytics, Refinitiv, and more. Scores are presented either by numerical ranges or by letter grades, depending on the score provider. In addition to this, advisors may perform climate scenario analysis and stress testing. Climate scenario analysis is an analysis that models how portfolios would perform under different climate futures. This analysis could be helpful for long-term investments as the climate slowly changes. Stress testing simulates short-term shocks that could significantly change a portfolio's performance. These shocks could include factors such as carbon tax hikes, extreme weather, or energy price spikes. This tests the resilience of the portfolio under adverse events. Now I'm going to show you an example of adjusting allocations for ESG. This is an example of a portfolio for a 40-year-old normal investor. Using the 110 rule, the investor has a portfolio of 70% stocks and 30% bonds. The stocks contain broad market indexes with no carbon screening and high exposure to fossil fuels, heavy industry, and low ESG rated issuers, while the bonds are just a mix of corporate and government bonds. The adjusted portfolio has the same weight of stocks and bonds, but with different asset selection. These stocks have a sector tilt to low carbon sectors, such as tech, renewable, and healthcares, while reducing oil and gas exposure. And the bonds are now a mix of green bonds and ESG screened corporate bonds.
Thank you, Jack. My name is Fred, and I'm going to talk about some of the important topics in risk management. One of the most important risk management tools is hedging. At its core, hedging is done to reduce potential losses from unpredictable events. In this context, that would include things like hurricanes, droughts, or regulatory changes. Therefore, the goal of hedging is to maintain portfolio stability and protect against long-term returns amid client and political volatility. One of the most powerful tools used in climate hedging is derivatives. Derivatives are financial instruments whose value is based on an underlying variable, like weather, emissions, or other indices. Their main purpose is to transfer climate-related risks into financial markets, actually turning environmental uncertainty into something that can be price traded and managed. To hedge and protect against climate-related risk, investors use a combination of approaches like these here, from portfolio diversification, green bonds and funds, as well as specialized derivatives like weather futures and carbon credits. These directly address climate exposures as climate risk is growing and more frequent natural disasters and shifting environmental policies are all the norm in today's world. Diversification, as Jack mentioned, spreads risk across different geographies and sectors, reducing the impact of any climate event. For instance, an investor might balance assets between renewable energy, traditional ones, or between coastal and inland properties to offset regional vulnerabilities. In green bonds and green funds, they are investment vehicles that exclusively finance sustainability-related projects like clean energy and resilient infrastructure. They let investors align capital with environmental goals while still earning returns. Climate derivatives are a little bit different, and the two most popular ones are weather futures and carbon credits. Weather futures are contracts that indemnify investors against an extreme weather risk. They pay out based on measurable conditions like temperature, rainfall, or snowfall, helping industries such as agriculture, energy, or tourism hedge against revenue fluctuations tied to weather events. Carbon credits are tradable permits that allow holders to emit a certain amount of carbon emissions. Since their value depends on the market price of that carbon, they're considered a derivative as well. So carbon credits help the market as they reward companies for cutting their emissions, excuse me. Risk managers also turn to certain financial tools and insurance-linked solutions, which include certain products like cat bonds or catastrophe bonds and parametric insurance. Parametric insurance actually pays out bonds for specific measurable parameters like wind speed and temperature, while catastrophe bonds actually are based off a certain event. So, for example, in catastrophe bonds, if a certain event, let's say there's $100 million hurricane cat bond for coastal properties in South Florida that earn a 6% yield if no hurricane hits. If a Category 3 or hurricane worse occurs, the investors have to lose their principal to cover that loss, but if it doesn't occur, they still will get these yields. Parametric insurance is a little bit different because it's based off of the certain parameters. So let's say a citrus farmer buys coverage for a drought with a rainfall threshold of less than 10 millimeters of rainfall in a month. If that isn't met, they instantly receive $500K payout automatically, regardless of actual crop losses. Some other insurance structures include insurance-linked securities and reinsurance structures that are both very interesting and involve the transfer of risk into global capital markets. All of these solutions provide liquidity and protection to consumers, and that's also why they're becoming more popular as well. Beyond derivatives, there are a lot of sector-specific strategies that also play a key role in managing climate risk. For example, in real estate, investors should use insurance, resilient construction, and geographic diversification to mitigate exposure to floods, fires, and seismic events. For retirement income portfolios, hedging may involve adding longevity and inflation protection since climate change directly increases living costs and market volatility. In private investments, it's essential to evaluate supply chain resilience and other operational vulnerabilities before committing capital. And lastly, in high value and illiquid assets, aligning protection strategies with both financial goals and climate realities is very important as well. So essentially, whether through hedging derivatives or other insurance-linked solutions, managing climate risk isn't just a sustainability initiative, it's become a necessity in today's day and age.
Thank you, Fred. Hi, everyone. My name is Kellen Rooney, and today I'm going to be going over the regulatory tax and reporting in the United States for ESG. So firstly, for regulations in the United States, we can look at it at both a federal and state level. At a federal level, the SEC recently adopted a climate disclosure rule in 2024, and their intent with this was to require companies to report their climate-related risks and emissions. However, after they attempted to adopt this, there was multiple legal battles and lawsuits pledged against the SEC. at the result of its attempted implementation. And because of this, they actually withdrew its defense in March of this year. So as of right now in Q3 of 2025, there is no single federal regulation on how companies must report their ESG numbers. However, at a state level, California is the most major player and the first to introduce climate regulations at a state level. We can see this in two Senate bills. First off, Senate Bill 253, which requires companies that do business in California to show their greenhouse gas emission disclosures. And then Senate Bill 261, which requires climate-related financial risk reports. And so these are not for companies that are headquartered in California. It is for any company making over $1 billion in revenue that do business in California that have to make these disclosures. However, at both a federal and state level, there are anti-greenwashing legislation in place from the FTC and state level. So in the last 2 years, the FTC has actually significantly increased its enforcement over their greenwashing rules. And if your company makes misleading claims, you can be subject to heavy fines. An example of this is the California Truth in Environmental Advertising Act, which requires third-party verification for environmental claims with major penalties for false advertising. Next up, looking at the corporate tax incentives. As of January 1st of this year, the IRA has implemented two tech-neutral clean energy credits. The first of which is Section 45Y, which is the Clean Electricity Production Credit, the PTC, which is for clean energy generation. An example of this is if a corporation was to conduct a wind farm to source energy for a new data center, you would look at how much the wind farm is outputting in terms of energy. So if the center outputs 500 milliwatt hours per year, which is 500 million kilowatt hours, you look at the current price of electricity. So we were to say it's 1.5 cents per kilowatt hour. The IRA will allow them to deduct that, which is 1.5 cents times 500 million, which is $7.5 million per year they're allowed to deduct from their corporate tax. The next one is Section 48E, which is the Clean Electricity Investment Credit, or the ITC. This is more for energy storage. And an example of this is that if a corporation was to build a large-scale energy storage facility with an eligible tax basis of $120 million, which means $120 million of assets put towards storing the energy itself, not just the entire building, the IRA will give them a base rate of 30% if the firm meets certain hiring incentives and requirements, which allows them to deduct from their corporate tax or directly pay themselves that amount. So 120 million times 30% would leave them with $36 million after the project is placed in service. And so for this, it's not projects made before January 1st of 2025. They have to be constructed, completed, and put into service after this went into place. And then finally, for ESG corporate reporting in the United States, as mentioned earlier, as of Q3 2025, there's no blanket federal mandate for ESG reporting. However, in the last 5 years, a lot of incentives have been shown for companies and C-suite members to disclose their ESG data to communicate their commitment to sustainability and responsible business practices for their shareholders. From this, two major ESG reporting frameworks have come out and are commonly used in the United States. The first of which 90% of S&P 500 companies report using it, and it's SASB, which is the Sustainability Accounting Standards Board, and it provides industry-specific standards for reporting ESG topics that can be linked to financial performance. So an example of this is that if you're a manufacturing company, you may want to report on your water usage versus if you're a technology company, you may be more inclined to report on your energy consumption. And then lastly, 85% of S&P 500 companies align with the Task Force on Climate-Related Financial Disclosures framework, and this focuses more on climate-related risks that are crucial to high-emission industries, such as airlines. They can report how much of their fuel is sustainable aviation fuel as opposed to regular fuel, how much it costs, and then they'll get credits based on the difference in cost there.
My name is Raiter, and I'm going to be speaking on the client advisory and recommendations from the perspective of a wealth manager. So when it comes to integrating ESG insights into the client strategy, the advisors are meant to bridge ESG and investment analysis with their application, which translates ESG, climate, and regulatory insights into personalized wealth strategies for their clients. Advisors will use their own professional expertise to integrate the many ESG tools we discussed earlier into a sustainable portfolio tailored to the client's unique values and expectations. And ESG advisory means guiding the clients through understanding sustainability impacts on returns and long-term wealth, applying portfolio diversification, insurance solutions, and carbon analysis to manage risks, as well as aligning investments with both regulatory compliance and personal values. And the final goal of this is to connect financial performance with meaningful positive ESG results. So the ESG advisory process has 5 steps. First, the advisor will go through discovery and alignment, where they use ESG profiling questionnaires to understand their clients' sustainability priorities and risk appetite. Then they're going to use the integration of insights, where they combine their top-down market signals with bottom-up company data to frame recommendations for their clients. Then they'll design the actual portfolio, where they apply diversification strategies and ESG scoring models from earlier to build balanced allocations that manage climate tail risk. And then they're going to implement this strategy when they pick the actual assets, and they're going to include green bonds, transition finance instruments, as well as insurance-linked products to hedge environmental exposures. And lastly, when they review and report, they're going to use stress testing and scenario analysis to measure portfolio resilience, and then report quarterly ESG progress with clear metrics and transparency. So it's very important that the managers understand their clients' priorities and align them with their ESG needs. So they should begin every ESG conversation with their client by understanding their unique values, lifestyle, and long-term objectives. They should identify which themes resonate most with that client. So, for example, it could be climate action, gender equality, community impact, or ethical governance. And then they should evaluate risk tolerance, time horizon, liquidity needs, and philanthropic interests as they would with any other portfolio. They should use ESG profiling tools or questionnaires to assess alignment between the client's values and investment preferences. So, an example of this would be if one of their clients is very passionate about clean energy, that manager might prioritize renewable focused ETFs in the portfolio. Or if a different client is focused on fair labor, then they may favor companies with verified supply chain ethics. It's very important that the portfolio manager communicates effectively with their clients. So they should provide transparent quarterly ESG performance reports alongside financial statements that translate impact into actual tangible outcomes if it's possible. An example of translating into tangible outcomes would be telling your client that their portfolio emissions have reduced 12% year over year. You should also track key non-financial metrics such as carbon intensity per dollar invested, diversity and inclusion scores of firms you're investing in, as well as board accountability and governance quality. Advisors can also help clients interpret risk-adjusted trade-offs. An example would be that lower exposure to high carbon sectors reduces volatility, or green and sustainability-linked bonds will offer predictable income with impact benefits. Effective reporting is a key way to build trust and long-term engagements with your clients, which is very important for a wealth manager. So transparency is another key thing if you're a wealth manager dealing with your clients. So they should use their knowledge of greenwashing risks and FTC enforcement trends to verify fund claims before they recommend products to their clients. They should verify fund methodologies, ESG rating scores, and proxy voting records before they invest. They should also explain to clients how regulatory changes might affect disclosure quality and investment reliability. They should integrate ESG reporting standards into client updates, which reinforce both compliance and authenticity. And they should highlight realistic expectations for their client. ESG investing seeks risk-adjusted returns and positive impact, but it does not guarantee outperformance. The advisor should be positioned as a gatekeeper that ensures credibility in every ESG recommendation. Transparent communication of ESG impact also works to build long-term advisor-client trust, which helps differentiate the credible advisors in a crowded market. When it comes to future opportunities and strategic recommendations, ESG advising now means anticipating fastly evolving policies, technologies, and opportunities. So we talked about tax incentives under the Inflation Reduction Act, which reward sustainable investments. And also transition finance and clean tech innovation is likely to reshape returns in the energy and infrastructure sectors. They should encourage clients to set measurable, sustainable targets supported by verifiable data. An example of this would be a goal to have carbon neutral portfolio by 2035. They should integrate hedging tools to protect long-term wealth, and they should emphasize that ESG integration is both a risk management tool and a growth strategy. The final takeaway is that advisors who leverage ESG analytics, reporting standards, and climate finance tools will guide clients towards portfolios that perform well, comply fully, and reflect lasting impact. Thank you for listening.